today's mini lesson is going to be about Section 174, Research and Development Cost Capitalization Rules, that was recently enacted and effective as of 1/31/2022. So it was originally a part of the Tax Cuts and Jobs Act. So let me go to the next slide. So prior to the Section 174 Tax Cuts and Jobs Act, companies could have the flexibility of choosing between deducting or capitalizing and amortizing research and development costs. However, because of the Tax Cuts and Jobs Act, there were new rules that were put in place by Congress and our then President Trump, who required companies to capitalize research and development costs and amortize them over specific periods of time. So for domestic cost or domestic R&D costs, they were required to be capitalized over 5 years, and then for foreign R&D costs, those were required to be capitalized and amortized over 15 years using a half-year convention method. So some of you might be thinking, why are we talking about this? Or what can we consider when thinking about what costs should be factored in for Section 174. So this is not a full list, but this is just an example of some certain costs that companies can consider when thinking about Section 174 costs that may need to be capitalized. So you have labor costs, which would be like your wages and salaries, materials and supplies, cost recovery allowances, patent cost, certain operation and management costs, so rent or depreciation. Travel costs can also be included, depending on what activity is tied to the travel cost. So if an engineer is traveling to go to a site where he's going to do R&D work, then that travel also would constitute a Section 174 cost. Now, why does this matter to us? So the nature of the companies that we work with are heavily technology startup companies, and they incur a lot of software development costs. So as part of Section 174, software development costs falls under this, and there's the requirement for these costs to be capitalized. And why is it important for us to pay attention to this for our clients? The main reason is that it will impact taxable income, because for book purposes, you are still allowed to, take those deductions on your P&L. However, for tax purposes, we cannot take those deductions. Instead, we have to capitalize it and amortize it. So that will lead us to having a temporary difference between what book has for R&D expenses versus what tax has for R&D expenses. And touching on a little legislative updates to Section 174. So there are talks about repealing this, and we talked about this last year during tax season. We were hopeful that it was going to be repealed last year. However, that was not the case. This is back on the table again, up for debate, and Congress is currently on recess until next week. So hopefully, next week when they come back, they will vote on the bill HR 7024 that passed the House, and that bill basically repealed the capitalization of domestic R&D expenses. So it would allow companies to expense all of those domestic R&D. Keep in mind that it didn't really apply to the foreign R&D, so that's something we still have to consider. So hopefully next week I'll have more updates regarding this one. And we can take a look at an example of how Section 174 affects our clients. I'm going to use one of our clients' tax return as an example. So when we have completed our financials, or the client has completed financials for the tax year, we put together a worksheet that basically summarizes the categories of expenses that we think there might be R&D related, and then we share this with the client. The client then populates columns C, D, and E for the percentage of expenses that is related to domestic R&D and foreign R&D. So the per financials column is what we are linking to the final profit and loss for the year. Once the client completes this, we would then enter it up. On our tax write-up, we have a tab for section 174. So on this tab, we have domestic allocation that the client populated, and then we have the amount that we need to capitalize. So instead of this amount of expense being taken as a deduction on the return, you'll instead see it on the fixed asset schedule, and it'll be capitalized and amortized over 5 years for domestic. This client did not have any foreign, so the 15-year amortization rule did not really apply to them. So how would that impact taxable income? So we have to add back the costs that were capitalized to our income for the TV to get back to our taxable income. And then we'll also subtract any amortization of R&D costs that were capitalized. So in this example, we have a total of $54,000 of amortization for 2023, but this $54,000 comprises of capitalization from 2022 and 2023. Would that impact taxable income? So we have to add back the costs that were capitalized to our income for the TV to